Volatility has spiked. On Monday, it went to 62 if you look at the VIX. But our next guest says these spikes of that magnitude, at least, usually they're short-lived, and they should revert to normal levels relatively quickly. Joining us now with more is David Miller. He's CIO of Catalyst Funds. We're seeing, of course, VIX up again today, not at 62, but I think around 52. How long does it usually take? And are we in a usually situation here?
Well, there's two very different scenarios. One is you have the V-bottom scenario where it's just a quick spike and then it goes away. Those are usually kind of one-time issues that are a quick shock to the system. The second issue is you have an ongoing recession, in which case the VIX can be particularly high for a long time. Certainly 60 is not normal by any means for a long period of time, but we've already seen it retreat significantly from there.
Tell me about the Catalyst Systemic Alpha Fund. How does this protect me? I want to throw a couple questions at you. What are the fees I'm going to pay if I move into this thing, and what's the return over the past couple of years?
Yeah, so the return of the fund is driven by this index that was created by BNP Paribas, and that index tracks multiple different indices that are all created by their design to not really track the returns of the S&P 500 or bonds in particular. They have many models that'll go in and out of markets based on things like the VIX, where they'll only be short the VIX if things are calm. It's a simple philosophy. If things are getting rough, you don't go sailing when there's a storm. And a lot of those models have been doing fine. The fund's roughly flat for the year, so certainly hasn't been down like the S&P has, or up like bonds this year.
And if I had put money in the fund 3 years ago, am I in the money or am I underwater?
So we recently launched that back in 2018 to start implementing that. So we had a great year last year. We had a rougher year in 2018 when all asset classes were down and flat this year. So you'd be up a bit if you started when we started going with it.
Is it designed, though, as a hedging mechanism to kind of guard against whatever the market is doing?
There's certainly aspects of it that are hedging in nature. So, for example, it has momentum models. And the thing about momentum models, if markets are trading up drastically or trading down drastically, that's the one thing that can really do well when outlier type environments work out, because they react to that. If markets keep crashing, they stay short. If they keep going up, they keep doing well with that. So it's not explicitly a hedge by nature, but when you have a great environment like a 2013 where things keep going up, or an awful environment like 2008, either of those can be good for momentum models.
With your funds, what's the appetite been for the past 3 weeks or so? Because on one hand, it's scary to catch a falling knife, but on the other hand, you could make some serious gains off of playing volatility. From your investors or prospective investors, have you seen any interest?
Yeah, we've certainly seen interest, or at least more stickiness of assets than you would otherwise to long-only funds, where there's been a more significant retreat. People are clearly seeing the value of these products at the moment, and that's really where flows have been.
All right. David Miller, CIO of Catalyst Funds, we appreciate your being here on The Move.
Thanks for having me.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.